90% of the secret to success is showing up and mindset, like knowing you can do it, believing you can do it. Educating and building that foundation, finding the right partnerships. You should go to anywhere where there's a network of like-minded individuals and entrepreneurs that are going to lift you up and encourage you to expand your mind and your beliefs of what you think is possible.
Welcome back to Broadcast Your Authority with Tamara Thompson. And I'm so excited to have a special guest tap in with us virtually today. Veena Jetti is the founding partner of Vive Funds, a unique commercial real estate firm that specializes in curating conservative opportunities for investors. Veena brings a dynamic perspective to targeting, acquiring, managing, and operating assets, and now has over $1 billion in assets. I was like, Veena, this is amazing. Thank you for being here.
Yes, thank you. Thank you for having me.
So tell me a little bit about this. Like literally, like how did you transact over $1 billion in real estate assets at this point? And where did you actually start this process?
It's interesting because I didn't set out with a goal to do this. And then it just kind of, as we got closer, I was like, okay, well, it's natural to try to go after the $1 billion mark. But I started in single family, and I shouldn't say impossible, but it's pretty near impossible to get to $1 billion in transaction volume on single family assets. And so when I started in single family, I was like, I need something that is more scalable than this. I need something that I can go in and buy 200, 300, 500 doors at a time. And that's when I really made the shift to multifamily. This was, almost a decade ago now. And I never looked back. So it was just adding one deal at a time and also scaling up on the size of deals we do. My first deal was $15.9 million. And my latest deal that I've done was just over $130 million. So,
and is that almost particularly in multifamily for the 15?
Yes, all multifamily. Okay. Yes, all multifamily.
Because you had said you started with single family, but how long were you actually focused on that before switching into multifamily?
I probably did it for about like 2 years, 2.5 years.
How did you actually like meet your network? Like, how did you get into this? Did you have a background in real estate, or is it something that you were passionate about?
Both. I come from a real estate family. So my mom is a very successful real estate investor, but she only invested in single family homes. And when I started my company, I thought you had to start with single family because I just didn't know that people could buy multifamily. And so I ended up buying multifamily assets by partnering with people who knew about how to do this. And so my single family homes, I bought houses that were anywhere from I bought one as cheap as $20,000. And then I paid, $600,000, $700,000, but definitely not at the scale of millions and millions of dollars.
If someone was trying to go into multifamily, like where would you suggest them to start if they've already started, dabbling in single family?
Yeah. So I think one thing is it's a misconception that you have to do single family before you do multifamily. I think you can absolutely start in multifamily. Second, I think that 90% of the secret to success is showing up and mindset, like knowing you can do it, believing you can do it. And so I would say you should go to anywhere where there's a network of like-minded individuals and entrepreneurs that are going to lift you up and encourage you to expand your mind and your beliefs of what you think is possible. And then the third part is educating and building that foundation, finding the right partnerships. And I have a Facebook community called Mastering Multifamily with Veena Jetti. It's a free Facebook group. I do a lot of education in there, but a lot of these terms, knowledge, everything is readily available online today. We're in the age of information, so everything is accessible.
I love that. We actually have a group of great co-hosts today, and we actually had an interview with Anthony Melchiori all about showing up, and his book's all about showing up as well. And we talked to Anthony Trucks earlier about mindset. And so I love the fact that you're in alignment with everything that every interview that we ever have on this show really transformed that. Guys, do you have any questions? Do you want to jump in?
I have one thing. Go ahead. We know that dealing in real estate, finding money, is probably the hardest thing you can do in business. I don't care how long you've been doing it. I don't care how successful you are. The next deal is a new deal. It's like a newborn baby. The baby's born, and hopefully the baby is healthy and the baby is good. Now, trust. Take the word trust in your business and in your first deal, first big deal. And how important was it that the people that you were in that business with, buying that first major multifamily, how important was trust?
Oh, I would say that's probably the cornerstone of even today, not even just the first deal, but even today, people invest with people that they know, like, and trust. And if you don't have any one of those three components, it's going to be very difficult to go out and raise capital. And especially when you want to do it at scale. And so everything that we do is built around transparency, integrity, the trust that our investors have in us. And I think actually this part of the market cycle is an interesting time to be talking about this, because we're starting to see deals that maybe aren't working out the way they were planned. And maybe investors are getting a capital call. And I've seen many deals now where there is a loss of principal, unfortunately. And this is the moment where things are tough that you get to establish that relationship of trust with your investors or not. So, deliver good news fast and bad news faster. And I think that absolutely helps to build that trust so that you can focus on the longevity of your relationship with your investors.
That statement, deliver good news fast and bad news faster, is true in every part of life. And that is one of the greatest quotes. It's so important. It's so critical because people can handle the truth. They can't handle you BSing around the truth, and especially in real estate. And I was fortunate enough to be a first vice president of asset manager for a big company in New York City. And I learned that the quickest way possible. When you go into those financials and you see a problem, you better not try to hide that. That better be the first thing you talk about, because the worst thing you can say is the next month is cash call. No one wants a cash call.
Exactly. And look, investors have some amount of risk tolerance, right? Like, that's why they're investing. They know that there's risk, but they're looking for the upside. And what I found, and it's hard as an operator to deliver bad news, right? But you have to do it. This is what you are paid to do. And every time I've had to deliver news that wasn't the most stellar news, it's always been received well when we did it early and with transparency and integrity.
Veena, I have a question for you. Is the capital institutional for you to scale, or is it high net worth accredited investors?
Yeah. So as of today, we have actually only raised capital from high net worth individuals and retail capital. It's not that we wouldn't raise money from institutional funds. It's just right now we haven't really had a need to do so. We've definitely had many conversations with some of the biggest institutions in the world, and the alignment for us to do that didn't really make sense, especially when our common equity and our high net worth investors or retail investors are being affected adversely. So we actually haven't taken in institutional capital to date. Doesn't mean we won't, we just haven't yet.
And right now, I would imagine it's very difficult to get institutional investors in this market.
I actually think it's interesting because in multifamily, especially Class B value add in the Sun Belt, which is what we primarily focus on, we're actually seeing a lot of interest from institutional investors. And then there's also the ESG component too, where we are a minority-led and woman-led company. And so they have certain funds set aside to try to support those initiatives. So they've been actually reaching out to us pretty strongly and significantly. It's just, it doesn't work for our business plan at the moment. And, I'll tell you, one of the hardest things that I've had to do was say no to $250 million in equity from a large institutional fund that I would love to partner with, but because it wasn't the right decision for our investors, we had to ultimately say no. So I'm sure these opportunities are going to continue evolving and changing. And I think a lot of capital that has been sidelined is now starting to come back online, or at least we'll see that in the next 3 to 6 months.
So Veena, I'm asked this question a lot. I've raised a lot of equity. My firm does on a daily basis through accredited investors. We've turned down institutional capital because I like control decisions, whether it's leasing to on a disposition, whether it's an acquisition. There's a lot of key decisions that come in throughout the process where institutional capital can tie your hands. How do you go about raising capital from high net worth individuals, accredited investors? What are some of your practices? I'm asked a lot about how do we raise equity? How do you go about raising equity?
Yeah. And I love what you said about institutional funds. It's the same with like really high net worth family offices. They always want control rights or major decision rights, which in certain scenarios would work and be okay. But the vast majority of the time, I want to maintain control too, because I want to be able to protect our investors. And that's something that's always been really important to us. As far as how we raise capital, I think one of the biggest things that I've done for the last like 6 or 7 years, I wish I would have done this sooner, is raising capital from investors when I don't have a deal on the table. So I'm primarily raising my capital before I have a deal on the table at all. The second thing that I think is really crucial in our capital raising scale is having systems and processes in place. Without them, it is just not possible to raise $60 million, $70 million, $100 million at a time. It is way too cumbersome and disorganized. So having good systems and processes in place and knowing and understanding what friction points your investors face so that you can remove or mitigate some of those friction points so it's as easy and as pleasant of an experience as possible to invest. And I think the third thing I would say to someone who is trying to raise capital is don't underestimate the value of a warm referral from one of your investors. So anytime I have an investor that says, hey, Veena, I'm so happy. I'm so glad we're working with you. I'm really excited, or thank you for something, any kind of positive feedback, my immediate response is, oh my gosh, thank you so much. I'm so glad you're having a great experience. Is there anyone in your network that you think would benefit from being connected to our investments or seeing our investment opportunities? And I'll set up individual calls with one of our investors. They'll get together 10, 20, 40 of their friends, and we'll do a Zoom call or an in-person meet so we can talk about the overall strategy and what kind of investments we look at, who it's appropriate for, because accredited investors hang out with other accredited people. And so it's the easiest way to get a lot of investors into your top of funnel and really grow your network for your investment opportunities.
So let's get into what's going on in this market. We know that there's a gap between the bid and the ask going on right now. It's been going on for a while. Sellers are expecting to get pricing that we saw a couple of years ago. Multifamily was selling at low yields. I am originally from Chicago, and some of the biggest icons in multifamily are based in Chicago. And I saw the cap rates that were trading at multifamily, whether it was 3, 4, or 5 caps, depending if you're in a coastal city or a 24-hour city. They're really low yields. How are you dealing with it in your portfolio with a rising interest rate market? You look at these portfolios that were trading at such low yields a few years ago, even years ago, and now you have to refinance. How is that affecting your portfolio? Because cap rates have to rise, and refinancing, lenders are all over the board with rates and cost of capital. How is this impacting you and your business?
I'm from Chicago too, actually. I grew up in Naperville, so fellow Chicagoan over here.
Absolutely.
Yes, we've definitely seen, obviously, a change to lending in the last 12 months, 18 months. And we've actually always planned for an increase in interest rates. And despite that, even our increases were not aggressive enough to meet the current reality of what's happening. So I think what we're seeing in today's market and environment is not so much about the deal or the pricing or anything like that, but it's actually about the cost of capital. So your blended cost of capital and be able to acquire assets with really great in-place debt. So as an example, we just bought a deal in Phoenix last month, and we assumed the debt on that. And our blended cost of capital across the whole asset, including the supplemental that we placed on it at close, is still under 3%. So with that, we're buying it at a sub 3% interest only for the next 7 years. And there's a heavy value add component, which is allowing us to operate at a significantly higher cap. But of course, our underwriting now is also showing a much more aggressive expansion on cap rates. Whereas even like 24 months ago, 36 months ago, you maybe saw 7 to 10 basis points per planned year of hold was a fairly reasonable assumption. And for us now, we're adjusting investor expectations to a 12 to 15% IRR when historically delivering 20% was not unusual. And so I think it's a combination of things. It's 1, finding great debt, 2, adjusting investor expectations, 3, making your underwriting assumptions a little bit more conservative than they've been historically, and 4, stress testing or running the sensitivity analysis to see all the different scenarios in which this could play out.
Are you finding that you have to go into tertiary markets in order to find that yield that your investors are looking at? Because I know from my experience, we've spoiled our investors, and it's what have you done? What have you done for me lately? That's the going concern. So Where do you go? Are you going to tertiary markets to find yield in this marketplace?
So we are not. We are still primarily in the nicest markets. We look for the sub-markets within those that have a little bit of a nicer tenant base and a higher tenant base. And it's funny that you're saying this about spoiling investors because we've done the same. There was an asset we exited last year. We bought it for $80 million, and then 18 months later, we sold it for $110 million. A lot of that was luck too. We happened to sell it at the exact right time. And, sometimes it's better to be lucky than good. But in that, we closed the deal, we sent out all distributions, and then we ended up getting a check back that we weren't expecting. And so maybe like 5 or 6 months after we closed, we send another check to investors, like an additional 4%. And they were like, thanks. Okay, why are we not getting 9% cash on cash in this other market that we're in? We're like, investor memories are so short, whether it's good or bad, they are short. They do not remember all of the great things you've done. That project delivered almost a 2x equity multiple over 18 months, which is an unheard of return in today's market. And so I always try to prep investors that we're probably not going to hit those same yields. I'm going to try, but it's unlikely. And so I actually educate our investors on the worst case scenario. And then we, try to underpromise and overdeliver, but we're not going out to tertiary markets yet. Our core of what we look for is like that core plus asset, even core, even value add in really nice submarkets where our median income in the area is usually about $100,000 or more.
Have you had a company that went out and was working with you, but then found a company that was like promising bigger returns, and then within a certain period of time came back to you and said, oops?
Yeah, all the time. And not so much companies as investors. I have a lot of investors in the last several years that were like, well, I could get 25% if I go and invest with this person. And I'm like, okay, let's look at what you're investing in. Let's compare, apples to apples here. And it's always a new build in Mobile, Alabama. And I'm like, well, I understand why you're getting 25% on new construction in a non-primary market. You should be getting that kind of return. But my assets are just a very stabilized hedge to some of the more riskier investments that you can make. And so I've had many investors that have made the decision to go invest somewhere else. And now they're calling me and they're going, I put in all this money with this person. Their capital calling me. They're telling me I'm about to lose all of my investment. And, it kind of sucks. Like, I don't know what to say because I'm like, this is part of the risk profile that you took on when you went into new dev or you chose to go into that market. And quite frankly, I think a lot of it is not even just the asset as much as it is the operator. I think that's the more important question mark. There have been a lot of real estate tourists that have popped up in the last couple of years because everything that glittered was gold. It was so easy. You could throw a dart and make money. And so we had a lot of part-time investors that popped up that have full-time jobs and just do this on the weekends. And I never really understood that because I work 100 hours a week only doing multifamily. So I don't really know how someone can be as knowledgeable about a market if they're not spending full-time on this.
Well, one thing you're going to see is there's a cleansing that goes on in these cycles. Yeah. I've seen it through my whole career. I actually love these type of markets because chaos causes opportunities. It provides a cleansing of people really that are in commercial real estate, maybe shouldn't be in commercial real estate because commercial real estate is a marathon business. And multifamily, hotel, self-storage, office, industrial, retail, all categories in the commercial real estate space. If I can offer you any advice, it's always the ability to hold. People think it's location. In commercial real estate, it's always the ability to hold because you know that throughout different cycles, cash flows are like moguls. It doesn't just ascend into the air like we all want it to. What do you do in your deals for your investors to create that ability to hold, to be able to ride through different cycles, have flexibility in your financing? What are some of your tricks that you put in your investment opportunities?
Yeah, I love this question. I think that recently kind of the motto of the multifamily world is survive till 2025 because of exactly what you said. It's not so much the location. It's not so much the asset class or anything like that. It's honestly your ability to weather the next couple of years of this interest rate environment and this chaos. So one thing that we've done, and we did this pretty early on, probably before interest rates really started rising, is we started looking for fixed rate debt products. So our debt is very favorable to being able to hold it through a market cycle. So in a very worst case scenario, we would anticipate that an investor maybe doesn't receive distributions, or maybe cash flow is halted, but there should be enough cash on the asset to, one, cover debt service payments, and two, not force us into a situation where we have to either relever or refinance, and we can't because either cap rates have expanded too much or our NOI isn't keeping up with where cap rates are expanding to.
Isn't it interesting how you'll suspend a distribution for a quarter or multiple quarters, and investors complain, but they also, on the other side, don't want to be hit with a capital call. So it's definitely the best way to do it.
Yeah.
You could build up reserves to build up that surplus for, that rainy day, that whether you have vacancy to capital improvement projects that you need.
And that comes back to the word trust,
Absolutely.
right? They trust you. They trust us like,
Absolutely.
listen, I've never done this before. We're gonna save the next couple of quarters for a rainy day, and that's what we're gonna do. And if they trust you, it's like, oh, okay, thanks. I got to go, do something else now. But it's that quick.
And that's why what you said of letting someone know the train's coming when bad news is so important, Veena, as I'm sure you're aware of, is because not everything's going to go perfect. If you're in the, I tell my investors, if I go 8 for 10 in my career with you, that's an incredible career. Now they expect 10 for 10, a lot of these investors, but just to have the ability to report to them when things aren't going as well as you think, or things change, or because some of these things are out of your control. You can't control certain economies, you can't control decisions, you can't control the supply chain and costs of materials. And so reporting on a frequent basis is so critical.
I'm thinking Ben needs to have Veena on your show, Ben.
Yeah, we might have to. We'll have to bring her on, especially we're
both
switching.
Of you are like super knowledgeable in the real estate.
Yeah, let's touch on a topic that's hot out there, is because I hear a lot from investors.
We do need to wrap up this one.
So let's touch on bonus depreciation, because multifamily is a big proponent of bonus depreciation that investors expect. One thing I hear from the multifamily sponsors is they're able to predict percentages. How does that work in your line of business with bonus depreciation?
So I don't like to say I can predict percentages. When investors do ask me for what they can expect, I give them like a pretty wide range, because it really does depend on the asset and what the cost segregation study says. But generally speaking, if someone invests $100,000, they're looking at anywhere from a negative $30,000 to negative $50,000 on their K1 in year one. Now, the interesting thing with bonus depreciation is if you're a new sponsor and you're trying to raise capital and you're talking about bonus depreciation, you have to know and understand that investors, and a lot of times their CPAs, do not understand what bonus depreciation means. So when you actually exit the deal or sell the asset and you've given them a whole bunch of money back, hopefully, they now have to recapture that depreciation. And if they don't understand that, you will get a million questions from them going, why do I have such a big tax bill at the end of this? And really the key is educating them that either if there's not a 1031 exchange opportunity available, that they get with their CPA and look for other investments to make within the same year that capital is being returned. So that way they can offset their capital gains issues that they're going to run into when the depreciation is recaptured. So it's definitely complex. It's a great selling point. People with a lot of money or that make a lot of money really do care about this. It's very tax efficient, but you need to make sure that you know and understand how to educate your investors, or bring someone on. Like I bring my tax strategist on my calls so that my investors can communicate directly with him and ask him questions, because this is like way outside of my pay grade. A certain like very base level, I know enough to be dangerous.
And let me put a bow on what she just said. So basically what the government does is they'll let you take that tax benefit, but you're going to make it up upon the sale. You're going to repay them back. And that's how it works.
Yeah. Anthony, did you have anything to add to
I was thinking about jumping in. I'm like, I could have hopped in, but I think it would have brought the intelligence of the conversation down. So I just bided my time to let it ride, man, to be quite honest.
Well, I appreciate it on that. And you two should definitely connect with Veena, Ben, because you two have a lot in common as well. And Ben actually has over $1 billion in real estate assets as well. So he's a very smart, got some wealth and knowledgeable people in the real estate space. But Veena, how can people find out more about Vive Funds, and how can they connect with you to learn more about what they're doing? If they want to come in, do they have to be an accredited investor? Do you work with other people that are not accredited investors? How does that work?
Yeah, so we exclusively raise capital from accredited investors, so you will have to be accredited. However, anybody can see my deals or can learn about multifamily if you connect with me on social media. I'm on Instagram, Veena Jetti, VeenaJetti. I'm on like every social media platform with Veena Jetti, or you can come hang out in my Facebook group, Mastering Multifamily with Veena Jetti.
I love it. Well, I appreciate you so much for joining us on the show today, and definitely stay connected. Let me know the next time you're in Phoenix.
Yes, thank you. Thank you for having me. This was so much fun. It was great to see all of you.
Awesome. And those of you that are watching, please subscribe, ring that bell, and make sure to leave us a review on Apple Podcasts for Broadcast Your Authority. We'll see you in the next episode.